In this review, you will have an insight, a reliable investment strategy that puts your hard-earned money at the forefront. Investing is more than just numbers on a screen. It involves substantial financial risks. A well-managed portfolio can pave the way to financial independence and early retirement, while poor management can lead to significant losses. The FALCON Method, named after the author's Hungarian surname meaning falcon, focuses on a specific and promising asset class: company shares. This method offers a systematic approach to navigate the complex financial landscape, providing an objective set of criteria to assess different businesses. Through a ranking system based on equations, the FALCON Method identifies the businesses most suitable for investment. In the upcoming sections, you'll discover why stocks are a dominant force, why a company resembles a black box, and how to effectively manage your portfolio once you've taken the plunge into investment. When it comes to various investment options such as stocks, options, bonds, mutual funds, and commodities, determining the most favorable choice can be overwhelming. Warren Buffett, an acclaimed investor, provides valuable insights to simplify this decision-making process. In a 2011 letter to shareholders, Buffett categorizes investments into 3 classes, highlighting his preferred one. The first class comprises currency-based investments, exemplified by bonds, which are essentially loans tied to a national currency. However, these investments are susceptible to a significant flaw: the risk of currency devaluation due to inflation. If the national currency's value increases, the invested amount loses its real value. Buffett's second category includes unproductive assets, such as commodities like wheat, oil, and gold. These investments do not generate additional income after acquisition. Their appeal lies in the hope of selling them at a profit later. The third and most favorable category, according to Buffett, consists of productive assets. These assets, like company shares or income-generating real estate, are not tied to a specific currency, providing flexibility in valuation. The best among productive assets, according to Buffett, are company shares. Owning shares signifies partial ownership in a company, granting shareholders a portion of its profits in the form of dividends. Additionally, shareholders retain the underlying value of their shares, which can be sold on the market when desired. Achieving effective investment in stocks necessitates a comprehensive understanding of how companies generate and utilize cash. Author David Van Knapp introduces the concept of a company as a black box, emphasizing the importance of analyzing its input and output pipes. As an outsider, the internal workings of the black box remain unknown, but the focus shifts to the cash flow dynamics. Input pipes, such as revenue and equity sales, represent the money entering the company, while output pipes include ongoing expenses, debt payments, acquisitions, and taxes. Profits, a crucial output, reveal valuable insights into investment opportunities. Key considerations include dividends as returns for shareholders, share buybacks to enhance share value and dividend per share, and retained earnings for company growth. The black box metaphor encourages a pragmatic approach, directing attention to visible and critical aspects of a company's financial operations. The FALCON Method advocates a strategic shift towards a buy and hold portfolio, emphasizing a prudent and long-term investment approach as opposed to the seemingly glamorous yet risky lifestyle of active stock trading often portrayed in popular imagination. Unlike the widely practiced quantum investing model, which relies on ranking stocks based on quantitative criteria, such as dividend per share, and involves periodic buying and selling, the FALCON Method introduces a more stable and patient strategy. This method encourages investors to retain their chosen stocks for an extended period, allowing for continuous dividend payouts and anticipating growth in the stock's intrinsic value. The FALCON Method addresses the drawbacks of the classic quant approach, such as the inclusion of unfamiliar companies and inconsistency due to periodic portfolio restructuring, by promoting familiarity and consistency through a buy and hold strategy. Additionally, the method recommends investing exclusively in reputable, well-known companies to enhance investor confidence. With a meticulously structured framework that incorporates human judgment only in the final phase, the FALCON method aims to mitigate psychological biases, ensuring that surviving stocks are considered above-average investment opportunities. In essence, it presents a thoughtful and disciplined approach to stock investment that prioritizes long-term value and stability over short-term gains and speculative trading. The initial step in implementing the FALCON method involves the meticulous selection of a cohort of high-caliber companies for the desired buy-and-hold portfolio. The method places a particular emphasis on companies that have consistently paid dividends for a minimum of 20 years without any reduction in the payout during this period. The rationale behind this focus on dividends stems from their status as the most reliable metric in corporate reporting. Unlike other financial indicators such as revenue and cash flow figures, which can be manipulated through unethical practices, dividends remain transparent and immune to such distortions. This commitment to dividend payments becomes even more crucial considering historical corporate scandals, such as the infamous case of Enron in 2001, where fraudulent accounting practices and falsified revenue reports led to the company's bankruptcy. While a 20-year time frame for evaluating dividend payments might seem extensive, it serves two essential purposes. Firstly, it allows for a comprehensive assessment of how a company's management responds during challenging periods, such as the global financial crisis in 2008. Secondly, consistent dividend payments signify a company's enduring earning power, making it a reliable indicator of financial stability. Companies with a track record of reliable and steady earnings tend to outperform in the market, evident in the recognition of certain companies as dividend aristocrats in the S&P 500 index. These elite firms have consistently increased their dividend payments for over 25 consecutive years. However, the FALCON method introduces a more flexible approach, avoiding the limitations of confining selections to the S&P 500 index and recognizing that maintaining a consistent dividend payment, even without consecutive increases, is a positive sign of financial health and strategic resource allocation. Thus, the FALCON method aims to identify companies with a substantial dividend history and a commitment to sustaining these payouts, acknowledging that while a strong dividend record is a positive indicator, it alone may not guarantee an exceptional investment opportunity.
Welcome back. Thank you for returning to our Knowledge Hub. Immerse yourself in inspiring book summaries with actionable insights. A special thank you for hitting that like, share, and subscribe button to reach a broader audience. In return, I'll deliver the best book summaries to catapult you into action and help you achieve your desired results. Now, let's get back to the review.
The second step in the implementation of the FALCON method involves the identification of stocks that can be acquired at favorable prices. Securing high-quality assets at discounted rates is undeniably gratifying, akin to stumbling upon a rare and valuable find. However, in the modern age of information accessibility on the Internet, sellers are more informed than ever about the worth of their goods. Genuine bargains are fleeting, swiftly seized upon discovery. Nonetheless, the pursuit of bargains remains essential in the realm of investments, and brevity can be an asset. In the investment landscape, a true bargain may be transitory, but the upside lies in the potential for prices to rise over time, aligning with the intrinsic value of the asset. The crux of obtaining a favorable deal lies in recognizing that every company is assigned a market price, subject to daily fluctuations. This market price differs from the company's underlying value, encompassing its assets, financial health, and future potential. By evaluating a company's intrinsic worth and considering the historical prices of its shares, investors can capitalize on discounts by acquiring shares in valuable companies when prices dip below the historically accepted average. The efficacy of this approach is rooted in the divergence between business-generated value and human set prices. Humans, as emotional and fickle beings, exhibit psychological biases, including feelings of greed and fear. These inherent human tendencies contribute to the volatility of stock market prices, evident in scenarios like a stock market panic, where investors hastily sell shares at lower prices. Strategic investors seize such moments, recognizing that during periods of pessimism, whether specific to an individual company or the broader economy, stock prices may dip relative to the stable underlying value of the asset. Acquiring shares in top-quality companies during these downturns becomes a reliable strategy for realizing substantial profits. However, executing this strategy demands a contrarian mindset, necessitating a willingness to dissent from prevailing market trends. It requires both extensive knowledge and a degree of courage. Importantly, investors must grasp that this market dynamic operates in both directions. Just as prices fall during times of panic, they rise during periods of euphoria. Prudent investors resist the allure of buying into the hype surrounding soaring stocks like Amazon, Google, or Walmart, recognizing the pitfalls of investing at inflated prices. The third step of the FALCON method involves the implementation of reliable filters to further refine the shortlisted stocks. While the initial shortlist has been curated, additional filtering based on advanced financial indicators is essential. The FALCON method incorporates three primary indicators in this filtering process: dividend yield, free cash flow yield, and shareholder yield. 1. Dividend yield. This indicator assesses the dividend a stock is expected to generate relative to its price. The calculation involves dividing the expected annual dividend by the current stock price. For instance, if a share in Microsoft is projected to pay $1, and the share is priced at $10, the dividend yield is 10%, 0.1. 2. Free cash flow yield. Often overlooked, free cash flow is the residual money after covering essential operational costs. Free cash flow yield gauges the relationship between this figure and the current market price of a share. The calculation involves determining the free cash flow per share by dividing a company's free cash flow by its total number of shares. This figure is then divided by the current market price of one share. For example, if Amazon's free cash flow is $200 with 100 existing shares, resulting in a free cash flow per share of $2, and the share is priced at $20, the free cash flow yield is 10%, 0.1. 3. Shareholder yield. This indicator quantifies the amount of money a company returns to its investors through dividends and share buybacks. Share repurchases occur when a company buys back its own shares on the open market, enhancing its ownership stake and increasing the value of remaining shares and future dividend payments. Calculating shareholder yield involves adding dividends and share repurchases and subtracting the value of new shares issued. The resulting figure is then divided by the company's market capitalization. For instance, if Google spends $100 on dividends, $150 on share repurchases, and issues $50 in new shares, and the market capitalization is $5,000, the shareholder yield is 4%, 0.04. When applying these filters, it's crucial to define minimum values for each indicator. While there's no fixed threshold, it's important not to set values too high, as this could make it challenging for companies with moderate values to pass all three filters. Even if a company passes one filter, it must successfully navigate the subsequent two hurdles. This multi-filter approach ensures a comprehensive evaluation of potential investment opportunities. In the fourth step of the FALCON method, the focus is on ranking the surviving stocks through a sophisticated approach known as weighted multi-factor ranking. Unlike simplistic one-dimensional ranking, this method considers multiple factors and determines the weight assigned to each factor in the ranking process. To illustrate this, let's consider two companies, Stock A and Stock B, evaluated on three factors: dividend yield, free cash flow yield, and shareholder yield. For simplicity, equal weighting is chosen, meaning each factor contributes 33.3% to the final score. The actual weightings can be customized, as long as they sum up to 100%. For instance, if Stock A has dividend, free cash flow, and shareholder yields of 5, 7, and 10% respectively, and Stock B has yields of 10, 5, and 12%, the final scores can be computed. By multiplying each yield percentage by the assigned weight and summing them, Stock A would have a final score of 7.3, while Stock B would score 8.9. However, since these three factors were already utilized as filters in a previous step, the FALCON method recommends incorporating new metrics for ranking. One such metric is a modified version of the Chowder Rule, which assesses a stock's current dividend in relation to its potential future growth. This involves adding a stock's dividend yield to the percentage by which its dividend has grown over the last 5 years. If the dividend yield is above 3%, the sum must exceed 12. If below 3%, it should surpass 15. Recognizing the potential limitations of focusing solely on a 5-year time frame, the FALCON method introduces flexibility by constructing multiple Chowder rules with different timeframes, such as 1, 3, or 5 years. Each of these rules is then treated as a factor in the weighted ranking, ensuring a more nuanced and comprehensive evaluation of stocks. In the fifth and final step of the FALCON method, the focus shifts to incorporating subjective judgment to refine the selection of stocks. While the method has heavily relied on quantitative indicators to eliminate bias, the inclusion of subjective judgment in this last phase ensures a careful consideration of qualitative factors. Here are some key aspects to consider in making the final decision. 1. ROIC, return on invested capital. Monitor the ROIC indicator, which stands for Return on Invested Capital. This metric assesses how efficiently a company's management allocates resources to profitable activities. A higher ROIC is indicative of better capital utilization and efficiency. 2. Avoid cyclical stocks. Exercise caution with cyclical stocks, which experience significant price fluctuations with large peaks and troughs. Cyclical trends are often observed in volatile industries, such as oil and cryptocurrency. The FALCON method recommends avoiding the extra risk associated with cyclical stocks, aligning with its buy and hold philosophy that favors steady, consistent growth over the long term. 3. Consider trading patterns. Assess the overall trading pattern of potential stocks. Understanding the historical price movements can provide insights into the stock's volatility and stability. The method emphasizes the importance of avoiding counterintuitive investments in cyclical stocks and prioritizing steady, long-term growth. While qualitative judgment, particularly regarding ROIC and trading patterns, can offer valuable insights, it's crucial to acknowledge that the first 4 steps of the FALCON method have already utilized structured rules and powerful financial indicators to identify top investment opportunities. While no investment method is flawless, the FALCON method, akin to its bird of prey namesake, demonstrates precision in its approach, ensuring a thorough and strategic selection process. Final summary: the FALCON method offers a meticulous and emotion-free investment strategy, emphasizing thorough company evaluation and a commitment to the buy and hold philosophy. This well-structured approach prioritizes long-term dividend-paying companies and employs stringent filters to sift through potential investments. By following the FALCON method's systematic steps and leveraging recommended financial indicators, ordinary traders can enhance their chances of wealth growth and create a sustainable passive income stream. Actionable advice: take the initiative to conduct your analysis. Apply the FALCON method's techniques by creating your list of companies. Consider referencing reputable indices like the Dow Jones Industrial Average or the S&P 500. Compile a list of companies with a history of long-term dividend payments, and begin your investment journey. Welcome back, and a heartfelt thank you for rejoining our knowledge-rich community. Within these digital walls, you'll discover a treasury of engaging book summaries crafted to equip you with insightful reflections and motivational narratives, encouraging profound actions. As we strive to broaden our impact and share the joy of learning, we extend an invitation for your support, simply by liking, sharing, and subscribing to our channel. Your support isn't just valued, it serves as the bedrock of our mission. In return, we commit to consistently furnish you with top-tier book summaries promptly. Let's persist in this collective journey toward growth and enlightenment. Here's to delightful reading, perpetual learning, and continuous personal development.